And welcome to today's Market Snapshot. My name's Craig Erlam, Senior Market Analyst at OANDA. Now today we'll start as always with a look at the markets, and we can see in Europe so far today we are trading quite deep in negative territory, following on from the similar moves that we had in Asia overnight. US futures currently trading down around 0.5 percentage point, so it looks like we're going to see a similar open on Wall Street in about an hour's time. I guess the most significant moves which we're seeing in the markets really does stem from Japan. We had the Nikkei close down around 3.6%. We've seen significant gains in the yen, and like I say, this does just come from the news we've had from Japan overnight. We talked about this in yesterday's video with the Bank of Japan monetary policy decision. We also had a lot of data due from Japan overnight, and as it turns out, this is really appeared to be driving the market so far today. Now, the Bank of Japan opted against adopting further stimulus overnight, despite the fact that we'd had these reports that last week that the Bank of Japan was considering negative lending rates, and this really is what sparked the moves in the yen. We saw the yen weakness off the back of that over the last few trading days. We've seen a significant reversal in these moves now. The yen trading down between 2.5% and 3% against the dollar, the euro, and the pound. And really, like I say, this does just stem from the fact that people have been waiting for the Bank of Japan to act. We've seen low inflation in the country. We've seen low growth, and the fact that we'd had this such significant yen appreciation since the start of the year, it did just seem inevitable that at some point the Bank of Japan was going to act. And following these reports last week, it did appear like that today was going to be the meeting at which we were going to get it, but we didn't get the announcement, and we have seen that sharp reaction in the markets off the back of that. Now, the interesting thing about this is this comes off the back of not just poor economic growth from Japan, it also comes off the back of we had weaker inflation figures overnight. Core inflation fell to minus 0.3%, and that's on an annualized basis. On an annual basis, even if you account for, or if you don't account for oil in this figure, that's still at 0.7%, well below the Bank of Japan's 2% inflation target. On top of this, we had the new forecast from the Bank of Japan. They revised down growth, they revised down inflation as well for the year, although for the next 2 years, although they did say they expected consumer inflation to hit 2.2% at some point next year, although given their forecast previously, it's hard to necessarily believe too much of that, especially considering how conditions are at the moment, and the fact that this significant yen strength compared to what we had at the start of the year is surely going to add further deflationary pressures here as well. So a surprising decision from the Bank of Japan overnight, and I guess now we'll have to look at the next meeting and see if this is being considered. The fact that we had these reports last week suggests that there is something there. They just decided that this was not the meeting in which to pursue it. We also had the Fed overnight as well. And the Fed, as expected, of course, didn't cut interest rates. They did release a statement alongside the meeting, though, and there was a couple of interesting points to it. I think the most significant of which was the removal of the risks that the global economic environment and also financial risks posed to the US economy. This was removed from the statement altogether, which suggests that the external factors which was potentially encouraging the Fed to remain at current interest rates is now subsided as far as they're concerned, which potentially suggests that they are more focused on the domestic situation and less so on the external environment. So that would suggest that, as they've alluded to previously, that the key thing now is going to be the domestic data. How is the economy performing? And if the economy continues to perform in line with expectations, then surely that would suggest that June is now back on the table. Now, the interesting thing here is, despite the fact that they removed these key risks, these key external risks from this statement, Fed funds futures now are pricing in only a 15% chance of an interest rate rise in June. Yesterday, you will remember that when we ran this video, that it was at 20%. It did fall as low as 1.2% at one stage, so we have had a bit of a whipsaw here in the Fed funds futures. At the moment, like I say, though, it's at 15%, which is lower than we had at the start of trading yesterday. So again, it'll be interesting to see how that continues to move over the next few days. Like I say, in my personal view, I do think this is slightly hawkish because of the removal of that key term, whereas clearly the markets have taken aspects of the meeting to be slightly dovish. The other sides of the FOMC statement were broadly balanced, though. They did touch on slowing economic activity, slowing household spending, but did also claimed that the incomes are rising at a solid rate. So clearly that suggests that there is potential for spending to pick up and inflation to pick up as well. But really, it was quite a balanced statement overall. And again, so I guess it will be interesting now to see over the next 2 months in the lead up to the June meeting how the data performs and the comments that we can get from the different Fed officials. Now let's take a look at the economic calendar for today. Like I said, we've got a lot of economic data still to come. Key focus is going to be on the US. We've got that GDP figure to come, and like I say, with the focus now being back on the economic data for the Fed, given that June is effectively a live meeting, then things like this GDP figures are going to be very important. Now we're only expecting 0.7% growth in Q1 on an annualized basis, but you'll remember the last 2 years we've also had very weak first quarters in the US. It does seem to be a pattern that has emerged in the US economy over the past few years, but then we have seen recoveries in the second, third and fourth quarters. The weak first quarter does tend to spread some fear throughout the markets and raise doubts about the potential for a rate hike, and it's not surprising that we're seeing the same again this time around. But what we want to be looking for in this data is any sign that this is more sustainable weakness and that this is not a repeat of the last 2 years. We've also got things like initial jobless claims as well. We've got GFK consumer confidence to come from the UK late on this evening, and we've also got earnings reports as well, which again has fed into sentiment in the markets overall this week, and I would expect to continue to do the same today for the rest today and tomorrow as well. For more in-depth news and analysis, check out OANDA MarketPulse at MarketPulse.com. You can also find out more about OANDA and sign up for a free demo account at OANDA.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.